Yo, what's up, guys? It's your boy Looney, and today I want to break down what I call the almost perfect options strategy. It's not truly perfect, nothing is, but it's the closest thing I found to a strategy that has a high win rate, keeps stress low, and works in bull, bear, and sideways markets. This is my go-to, and that is selling options and running the wheel strategy. And it became very real to me again this week because I got assigned on two leverage ETFs, one tied to HIMS and one tied to CoreWeave. And instead of panicking, I'm turning both assignments into pure income by selling covered calls. Before we jump in, shout out to the Discord. It is free to join. The premium version is $8 a month, and you get coaching, call outs, and an option selling course, giveaways, and more. All the links are in the description. Let's get into it. So the wheel strategy, I would say, is almost perfect system. In a perfect environment, it is one of the best strategies. But again, the markets aren't efficient and they're not always going to work. The strategy is not always going to be the best to do. Because a lot of traders like to complicate options. They try to time the tops, the bottoms, volatility, gamma ramps, all that stuff. But using the wheel strategy, it's simple, it's repeatable, and most importantly, it pays you for being patient. So what is the wheel strategy? The way it works is you sell a cash secured put on a stock or ETF you're comfortable owning. And then if you get assigned, meaning the stock trades below whatever strike price you had on expiration, then you get assigned and you are forced to buy 100 shares at that strike price that you set. And then once you have those shares, you can sell covered calls against those shares, collect income. And again, if you face assignment, but in covered calls scenario, the stock has to be trading above your strike price. Then those shares get sold away and you take profit, and then you could restart the whole process again with selling cash secured puts. So you either collect premium, lower your cost basis, or you get paid to sell shares at a higher price. And you win. You win as long as you're willing to own the underlying. So in this week is a good example that I have in my own portfolio. So I did get assigned. Let's actually look at both of these. I got one to HIMS and one that was assigned for CoreWeave. Both are leveraged positions. But most people often panic when they hear leveraged assignments. And I wasn't stressed for the reason because I sold the puts on purpose. I was already comfortable owning them at my strike price. An assignment simply just moved me to step 2 of the wheel. And because I got assigned, I can now sell covered calls. And that's exactly what I'm doing. I got assigned on CoreWeave. I actually got assigned early. I made a video on this. And I am now selling a covered call at the $8 above my strike price. And I'm selling another put at the $5 to lower my cost basis as well. And another cool thing that I did is I used that premium that I collected from the covered call. I got $20 and I bought one share. So one of the biggest issues with covered calls is they limit your upside. But by using partially of the premium and buying a share, I can take advantage if CoreWeave or this leverage position goes past my strike price. And although it's only one share, we'll see. Maybe I'll do more. And if I get assigned at this $5 put, then I could sell another covered call and do the similar process. But rebuying the shares and doing lower cash secured puts lowers my cost basis. And I get to continue the income cycle with covered calls. And this is why the wheel feels almost perfect. Because when something goes wrong, like right now, I'm down 33%, like assignment, you're actually just moving to the next profitable step. Because if I sell a covered call at 8 and CoreWeave goes above 8, I'll be forced to sell at 8 and my average cost is less than that. And that doesn't account for my premium that I got on the $8 call. And then also I have even more shares than that 100. And if CoreWeave doesn't go above 8, then I could keep doing the process. I get my premium as a total return or a realized return or a realized profit. And then I can sell another covered call, collecting and generating more income and doing whatever I want with that income. So that's one on CoreWeave, we're going to get into HIMS, but I do want to just stop because leverage ETFs are not long-term investments. Because it's very important to know this. Leverage ETFs are not meant to be held long-term. They actually even say it if you click on it for, I think on Robinhood itself. Yeah, it says somewhere around here that they're not meant for, they're designed for short-term use. Now, they decay over time, and that is due to rebalancing, volatility drag, compounding effects, and the fact that they're designed for short-term directional trading is kind of why I'm only selling options on them and trying to do the wheel strategy. I'm trying to be in and out. This isn't a long-term play, but if CoreWeave stays below my cost basis, I will continue to sell covered calls and I guess hold this for a little bit longer. But I don't plan to hold this for 10 years because that's what I see as a long-term investment is 10 years. But maybe I'll go to a year. Maybe I'll go to 2. Who really knows? I don't know where this position is going to go in the next month or next year. But with leverage ETFs, you can trade the stock at a discount and obviously more risk, and the premiums are a little bit higher because of this. But I am doing this. I'm sizing small. This isn't my entire portfolio. It's only 1% of my portfolio, and I am actively managing them. My goal here is income, not long-term holding. So I'm not holding these for years. I'm not marrying the position. I'm using this assignment as short-term opportunity to sell covered calls and hopefully exit with profitability. So if you're newer, only run the wheel on leverage ETFs if you understand the added risk. Regular stocks or normal ETFs are much safer. Now, HIMS has a little bit less stress. My average cost or my total return isn't as bad. And the stress with selling options is, I would say, considerably lower than most trading strategies because it is not defined risk. So although I lost on my cash secured put, which I wouldn't even consider losing, all that happens was I turned my cash into shares, and then those shares I can sell covered calls on. And also I'm buying the shares at what I feel is a discount. Because usually the stress in trading is from guessing direction, trying to time entries, chasing pumps, panicking on dips. The wheel and selling options eliminates most of that because really the mindset becomes, if I get assigned, that's fine. I wanted the shares anyway. And also volatile days, the premiums are better and they're higher. So you could sell puts at a better time. Also, other way, calls or covered calls are really good when the stock shoots up a bunch. But when there is low volatility, it's hard for your premiums are a lot lower. And if you get assignment, that's a good part. And a good thing about this, it's repeatable. You could restart the trade. There's not much panic. There's no rushing. There's no guessing the bottoms. It's just a repeatable system. So let's actually look at HIM because I got assigned. I also own HIMS itself, but to do a cash secured put on HIMS, I would need a lot more. I would need around 3,400, whereas in this position, the HIMZ, I only needed around 700 or 800, so that's a fraction, and I got to do the similar trade and capitalize on these discounted prices. And now I could sell covered calls. So this one, I'm in a better scenario, so I can, if I do trade options, I can do a covered call at a higher cost basis, maybe the December 19th one, and I'll go like 30 or 20 delta. And you can see these premiums are pretty good. So I would get $40 if I did this $10 one. And that would be a gain of around 300 because my average cost is 7.3. And then I would be selling this at 10.4. So I'd make around 300 if HIMS shoots up to $10, which can happen. These are very volatile positions. These are leverage positions. And who knows, maybe I'll use part of that premium like I did with CoreWeave and buy the shares, but we'll see if I only really do that if my total return is negative. If my cost basis is positive or it's below whatever the current price is, then I'll just kind of have that premium and I'll just kind of have it sitting in my cash and maybe use it for a different trade. But doing this, I could reduce my cost basis. Maybe I could sell more covered calls at $6 or $5 and figure out what to do through all these assignments. But overall, this strategy is great for consistent income. The true key here is discipline. It's not about direction. I don't need HIMS to double overnight. I can be patient. I could sell covered calls monthly, and if it doesn't hit my strike price, I could just keep doing it, repeating it until I finally get signed. And I'm not really guessing on direction. I'm really just saying I'm okay with selling it at whatever price and also buying it at whatever price. So yeah, selling puts, taking assignments, and selling covered calls. It's not flashy, but it's not gambling. It's one of the highest win rate, lowest stress strategies I have used ever. And even getting assigned on leverage ETFs, which are a lot more riskier, I didn't really get emotional or it didn't bother me because the wheel makes the assignment part of the plan, not failure. Now, I didn't really go over too much in this video, but I am being strategic with it. I'm not going all in with these trades. You can see these are small portfolio or small positions in my portfolio, and I'm allowed to lower my cost base by doing different strike prices. So that's very important. With CoreWeave, I'm able to take advantage if the stock or the ETF drops lower, and I could do more trades, lower my cost basis, and just being smarter with it. But if you enjoyed this breakdown, drop a like and comment. What wheels are you running right now? And subscribe for more. Until next time, peace.